Welcome back, it's Douglas Beck here with the Growth Collective. In today's video, we're diving into how commercial real estate investors maximize returns to scale their portfolios. Whether you're looking to grow your holdings, optimize cash flow, or structure smarter deals, I'll break down key strategies you can use right now. Before we get started, hit that subscribe button so you don't miss more insights on real estate investing and scaling your business. Let's jump in. I hear this a lot in the commercial real estate circles is like this. When you look at how, let's say, an accredited investor typically looks at investing, they say there's two sort of streams of how they could invest capital. One stream is going to be for cash flow, right? Cash flow means they're getting income from their investment. They're getting consistent return on investment in the form of income on a monthly or quarterly basis. This comes from typically an income producing asset, call it a multifamily building, call it a self-storage facility, call it something spitting out income, right? A well-managed hotel, right? An industrial warehouse, a flex space, medical office that's occupied, a triple net lease on a strip center. These are the kinds of assets that produce reliable income. On the other side, you have people looking for growth, what some people call appreciation. And with that, it's not the same as income because we're talking about two drastically different things. It's hard to have income and also growth, right? And appreciation. It's really hard to balance those or have like the greatest of both of those things. Most deals have either really good income potential or the current income and they're stabilized and they're getting spitting out income like no problem, or they have really good growth potential, but they have like no income or very low end. They're not there yet. They're not fully optimized. In the middle, it's kind of tough to find. Like that's where you find in commercial real estate, you find what people will call value add. What's a value add opportunity? Well, something where you could put in time, money, improvements, better management, etc., to make the asset better. Well, if I can do that, if I can add value to the property and I can increase the collection of rents, for example, in a commercial piece of real estate, right? Or if I add value, now I increase the value of a piece of residential real estate. Well, now I just created growth because I put in money, time, and effort. And it doesn't need to be all my money, time, and effort. It could be other people's money, time, and effort, but it has to be managed well. Then I could realize that growth in the form of a sale or a refinance, right? So what you see with most larger deals, most commercial real estate investors are either doing one of two things at the end. They're usually, they only can really sell the property or refinance the property. They're not going to sit there and keep everybody who's been in the deal from the beginning right where they're at. They're not going to sit there and keep their capital invested forever. What they typically do is they either exit through a sale or they exit through a refinance. So I'm telling you that the players, the people that do massive deals, that do, tens of millions, hundreds of $1 million type deals, they're not going to just like put their own money in the deal and leave their money there forever, just to be very real and candid with you guys. And there's a very good intention as to why not, because they need to keep the money moving. Their money has to move through property. And they want to also avoid a lot of times, like if you talk to Michael Amos, for example, other people like him, they want to avoid having to pay taxes, like legally avoiding paying taxes by mitigating the burden of paying taxes, which is typically from, income, ordinary income. They want to have real estate to depreciate and write off and things of that nature. And they have an interest expense that they can write off if they have a loan. And when you take a loan against a piece of real estate, it produces what's called a non-taxable event. The money you borrow against a piece of real estate isn't income. Borrowed money is not income. Borrowed money is a loan to be paid back. Borrowed money can be invested. So if I borrow money against, let's say, like Steve presented his deal before, if he borrows in the form of, let's say, a DSC or a loan, right? He gets a commercial loan against his residential real estate, and as he owns it in an entity, we'll say, he could not have to be personally liable, right? He doesn't have to be personally responsible. His property is producing, let's say, enough income to service that debt. And now he can access his equity and get liquidity, right? Meaning money in his hands to then take that equity and contribute it into the next thing. And you might see some of these, if you look up like people that believe in like the Burr process, right? Buy, renovate, rent, refi. There's this concept of snowballing where you basically have one house and then you buy, renovate it, you refinance it, and then you rent it out, refinance it, and then you turn that one house into two houses. You keep that house, and then you have another house that you buy with the down payment that you pulled out as an equity. And it's harder to do this because of rates, by the way, but this is the model. You take one house, turn into two. You take two houses, turn into three or four. Three or four turns into 5 or 6, and that's how people grow. All right, I hope this gave you some clear strategies for maximizing returns and scaling your commercial real estate portfolio. These principles can make a huge difference whether you're starting out or fine-tuning your approach. If this was helpful, share your thoughts in the comments below and pass this video along to someone who could use it. Thanks for watching, and I'll see you in the next one.